No empire in history has ever collapsed solely due to war. From the debasement of Rome to the fading sun of the British Empire, the end always begins with the currency. Fast forward to July 2025. This is not a political cycle. It is a mathematical inevitability. The United States national debt has officially breached $37.2 trillion. But stop looking at the headline number. The total debt is irrelevant. The only thing that matters now is the interest. Read the data like a classified Federal Reserve memo. We are facing a refinancing wall of biblical proportions. Over the next 12 months, the U.S. Treasury must flood the market with $11 trillion in bonds, $9 trillion to roll over old debt, and $2 trillion to fund new spending. Do not confuse this with a standard budget deficit. This is a liquidity heart attack. For decades, the world bought our debt without question, but the buyers have vanished. The global game of musical chairs has finally stopped, and for the first time in history, the United States is standing without a seat. Washington knows the truth. They cannot pay this back. The math is broken. The old playbook, Project Doge, spending cuts, austerity, is already dead on arrival. They are no longer trying to fix the economy. They are preparing to reprice the entire system. The plan has secretly shifted to two specific radical mechanisms that most Americans have never heard of: the Genius Act and gold revaluation. Most investors are staring at stock charts, terrified of a recession. They are looking at the wrong data. The greatest transfer of wealth in history has already begun, and it isn't happening on the stock market. Watch closely. To understand the severity of this crisis, you have to ignore the political theater and look solely at the math. The United States is currently staring down the barrel of a $37.2 trillion debt load. But the danger isn't just the size of the pile, it's the timeline of the bill. Most people confuse new debt with rollover debt. New debt is the extra money the government borrows to fund this year's overspending, about $2 trillion. That's bad enough, but the real monster hiding in the basement is the rollover debt. This year, a staggering $9 trillion of existing U.S. debt matures. This is debt that was borrowed years ago, back when interest rates were near 0%. That cheap money era is over. Now the Treasury has to pay back those old lenders. But they don't have the cash, so they have to borrow new money to pay off the old money. But here is the trap. They are refinancing that $9 trillion, but not at 0.5%, but at 4 or 5%. Imagine you maxed out a credit card at a 1% teaser rate, and suddenly the bank resets the rate to 20%. That is exactly what is happening to the U.S. government, on a scale that defies comprehension. They need to sell $11 trillion in treasuries in a single year just to keep the scheme alive. This refinancing creates a cash flow nightmare. We have reached a grotesque milestone in American history. For the first time, the cost of simply servicing the national debt has surpassed the entire national defense budget. We spend about $850 billion a year on the military. We are now spending more than that just on interest payments. We are paying more to bondholders than we are to the Army, Navy, and Air Force combined. And the system is incredibly fragile. The math is razor thin. If interest rates rise by just 1%, a tiny fluctuation in normal times, the U.S. government owes an additional $370 billion per year in interest expense. Think about that. 1% equals nearly half the defense budget. This is the definition of unpayable. You cannot tax your way out of a hole that grows by $370 billion every time the Federal Reserve blinks. The only way to pay this bill is to print the money, which dilutes every dollar in your pocket. And this brings us to the final nail in the coffin, the buyer's strike. For 40 years, the United States had a reliable customer base. When we issued debt, foreign governments lined up to buy it. China and Japan used their trade surpluses to soak up our treasuries. That era is dead. China and Japan are no longer the reliable buyers they once were. They are selling. The United States government is now behaving like a failing company, issuing more stock that nobody wants to buy. And when demand for your debt dries up, the laws of economics take over. If there aren't enough people willing to lend the government $11 trillion at 4%, the government has no choice but to offer a higher return. They have to bribe lenders with 5, 6, or 7% yields just to get them to the table. But remember the math we just did? Higher rates explode the interest payments. This is the death spiral. We are not approaching the event horizon, we are already inside it. And this is exactly why the old plan of simple budget cuts was doomed before it even started. To understand why the crash is inevitable, we must leave the political stage and enter the engine room of the collapse. The Treasury auction. This is the scariest room in global finance, yet 99% of Americans don't even know it exists. Most citizens believe the government just prints money to spend it. That is technically incorrect. The government borrows money by issuing IOUs called U.S. Treasuries. They take this paper to the market and ask the world to lend them cash. In a normal economy, banks and foreign nations line up to buy. But we are not in a normal economy. We are in a saturation crisis. The Treasury needs to sell 11 trillion of these IOUs over the next 12 months. Here is the mechanism that keeps Federal Reserve officials awake at night. Supply and demand. The government is flooding the market with supply. But if demand is weak, if there aren't enough people willing to lend the government that money, the auction fails. To attract buyers, the government has no choice but to offer a higher payout. They must raise the interest rate. When the bidders step back, the yield forces its way up. The market is effectively saying, if you want our money, you are going to pay for it. What happens if an auction fails? If the government offers a 4% return and nobody buys, they have to come back and offer 4.25%, then 4.5, then 5. This might sound like a small change, but in the bond market, it is a violent repricing. This dynamic has resurrected a force we haven't seen in decades: the bond vigilantes. These are the lenders who are no longer blindly trusting the US dollar. They see the $37 trillion debt, and they are demanding higher pay for the risk of holding US paper. If the interest rate goes up to attract these skeptical lenders, the cost to service the national debt explodes. A mere 1% increase in rates translates to hundreds of billions in extra interest expense every single year. We are watching a credit freeze in real time. If the treasury market breaks, the stock market crashes, credit stops flowing, and the real economy grinds to a halt. This mechanism creates a fatal flaw in President Trump's vision for the future. A core pillar of the new administration is to bring manufacturing back home. We want to see Made in USA stamped on steel, cars, and microchips. But here's the paradox. You cannot rebuild the industrial base of a nation with interest rates at 6 or 7%. Building factories requires massive capital. Buying heavy equipment requires financing. Infrastructure requires loans. Factories run on credit. If the bond market pushes interest rates up because of the debt crisis, the cost of borrowing becomes too high for businesses to expand. The reindustrialization plan dies before the first brick is laid because the financing is simply not feasible. The government is trapped. They need low interest rates to save the economy and rebuild manufacturing. But the market is demanding high interest rates to buy the debt. Washington has lost control of the price of money, and when a government loses control of its rates, it usually tries to change the rules of the game entirely. For a brief moment there was hope. The narrative sold to the American public was that a team of outsiders, led by Elon Musk and the Department of Government Efficiency, or DOGE, would sweep into Washington and slash the budget. The promise was bold. Cut $2 trillion from annual federal spending. It sounded perfect. It sounded like a business turnaround. But running a sovereign nation is not like running Twitter. Here is the reality check that killed the dream. The US government spends about $7 trillion a year, but the vast majority of that money is already spoken for by law. It goes to Social Security, Medicare, defense, and interest on the debt. To hit Elon Musk's $2 trillion target, you cannot just fire a few bureaucrats. You would have to slash retirement checks for the elderly or gut the US military by 50%. In Washington, that is not called efficiency. That is called political suicide. No politician will vote to starve their own voters. The math simply does not allow for a $2 trillion cut without collapsing the social contract. But there is a deeper, darker economic reason why austerity failed. It is a trap hidden in the very definition of our economy. Economists measure the health of the nation using gross domestic product. The formula is etched in stone. GDP equals consumption plus investment plus government spending. It has become such a massive percentage of the economy. But it is now a load-bearing wall. If you actually succeeded in cutting spending by $2 trillion, you would instantly wipe out $2 trillion of GDP. That is not a correction. That is the Great Depression. Here is the paradox. If you cut spending to pay off debt, you trigger a severe recession. In a recession, businesses fail and people lose jobs. When people lose jobs, they pay less in taxes, so the government's revenue collapses. The result, the debt-to-GDP ratio, the most important metric of financial health, actually increases because the economy shrinks faster than the debt does. You end up with a smaller economy and a bigger relative debt problem. The cure kills the patient. You don't have to take my word for it. Look at the scoreboard. The data for 2025 is already coming in, and it paints a brutal picture. Despite all the headlines about efficiency and cost-cutting, the federal deficit is actually worse this year than it was at the same time last year. The government didn't save $2 trillion. They didn't even save $1 trillion. The spending machine is accelerating. DOGE was not a fiscal solution. It was a marketing campaign. The claimed savings were mostly hypothetical projections over 10 years, accounting errors, and wishful thinking. The system is too addicted to the liquidity. The politicians, the lobbyists, and the defense contractors will never allow the money spigot to be turned off, so we have arrived at the dead end. Plan A, austerity, is mathematically impossible and politically toxic. They must stop trying to fix the budget and start trying to manipulate the money itself. This is the pivot to Plan B. Since Plan A is dead, the government has quietly activated Plan B. This is where the narrative shifts. You've heard politicians suddenly talking about crypto freedom and strategic reserves. Do not be naive. This is not about freedom. This is about liquidity. The centerpiece of this strategy is a piece of legislation known as the Genius Act. Buried in the details is a mechanism that changes the plumbing of the financial system. It requires stablecoins, digital dollars like USDT or USDC, to be backed by US dollars or short-term treasury bills. Here is the genius and the cynicism of the play. Washington is betting that the crypto market will grow from $4 trillion to $10 trillion or more. As crypto grows, the demand for stablecoins grows. And because of this act, every new stablecoin minted creates a forced buyer for US government debt. If the crypto market doubles, it could inadvertently soak up $2 or $3 trillion in treasuries. Effectively, they are privatizing the monetization of debt. They are using the crypto bros to save the US Treasury from the bond vigilantes. It creates a new source of demand to keep interest rates artificially low. But even crypto might not be enough to plug a $37 trillion hole. That is why they are dusting off the nuclear options. Enter Judy Shelton, President Trump's former economic advisor and a longtime critic of the Federal Reserve. She and others in the inner circle are looking at the one asset on the government's balance sheet that hasn't been touched in decades, the gold reserves. The United States Treasury officially holds 261 million troy ounces of gold. But here's the secret weapon. On the government's books, this gold is valued at a statutory rate of just $42.22 per ounce. This is a relic of history, a ghost price from the 1,970s. The real market price is over $3,400. This creates an opportunity for the ultimate bookkeeping trick. The president has the legal authority to reprice this gold. He does not need Congress. He does not need a vote. He can simply sign an executive order revaluing the gold to market price, or even a shadow price, calculated to cover the monetary base, potentially as high as $15,000 per ounce. If Trump revalues gold to $15,000, the Treasury instantly creates roughly $4 trillion in new equity out of thin air. The Federal Reserve would be required to print the difference and hand it to the Treasury. Suddenly, the government has $4 trillion in cash, free and clear, to pay down debt or fund the deficit without issuing a single new bond. This sounds like a conspiracy theory. It sounds like alchemy. But the intellectual curious viewer knows the truth. This is the standard playbook. Franklin D. Roosevelt did it in 1933 when he confiscated gold and revalued it to devalue the dollar. Richard Nixon did it in 1971 when he closed the gold window. Every time the U.S. government runs out of money, they change the value of the money. They are not fixing the debt. They are rigging the ledger. And while this might save the government, it signals to the world that the fiat experiment is entering its final volatile phase. Let's step back and look at the chessboard. We have analyzed the debt spiral, the bond vigilantes, the failure of austerity, and the radical pivot to crypto and gold. But if you think these new plans are designed to solve the debt crisis, you are missing the point. They are not solutions. They are sedatives. The Genius Act and the gold revaluation are merely sophisticated ways to buy time. The establishment knows the math is broken. They know $37 trillion can never be paid back in honest money. So, what is the real objective? It is a desperate attempt to keep interest rates artificially low for just a few more years. Why? Because they need a window to rebuild the American industrial base. They know that if the bond market collapses today, the factories will never be built. The reshoring of manufacturing will die in a credit crunch. So they are using crypto liquidity and gold accounting tricks to suppress yields, essentially printing money through the back door to keep the show going. But there is a trade-off. In economics, there is always a trade-off. To save the bond market from crashing, they must sacrifice the currency. They are choosing to burn the purchasing power of the dollar to keep the government solvent. They are saving the system by sacrificing your savings. There is a specific date driving this entire frantic strategy. July 4th, 2026. This will be the 250th anniversary of the United States. Psychologically and politically, the government cannot allow the system to collapse before this symbolic milestone. It would be a humiliation on the global stage. They are desperate to hold the facade together until the fishworks go off. Think of these crypto and gold maneuvers as a bridge. They are frantically laying down planks in front of a speeding train, hoping to reach the other side of 2026 without a derailment. But the question every crisis anticipator must ask is, where does this bridge lead? Does it lead to a revitalized, manufacturing-based economy? Or does it lead to a cliff? History suggests that when a government resorts to revaluing its own gold and monetizing its own debt, the bridge usually collapses under its own weight. So where does this leave you? While the government plays these high-level accounting games, revaluing gold to $15,000 or backing stablecoins with T-bills, the reality on the ground will be very different. You will see the stock market rise. You might even see Bitcoin explode, but do not confuse rising prices with getting richer. This is the inflation tax. As they dilute their currency to pay their debts, the cost of your life, food, energy, insurance, housing will continue to climb. This is the ultimate wealth transfer. It moves purchasing power from the middle class, who hold cash, to the state and the asset owners, who hold the debt and the gold. The system is working exactly as designed, but it is not designed to protect the citizen. It is designed to protect the state. Washington has made its choice. They will inflate the debt away. The only variable left in the equation is you. There is no happy ending to this story. There is no magic policy that turns the clock back to 1990. The cold reality is simple. The debt will never be paid back. It is mathematically impossible. It will either be defaulted on, which destroys the world economy, or it will be inflated away and re-raped against gold. The government has clearly chosen the second path. The old rules of money are dead. The 60/40 portfolio is a relic of a time when bonds were safe. Bonds are no longer a sanctuary. They are the epicenter of the blast zone. History shows that when a nation turns to accounting tricks to hide its insolvency, the end is not near. It is already here. The Genius Act and the gold revaluation are not signs of innovation or strength. They are the flailing motions of a drowning swimmer. They are signs of absolute desperation from an elite class that has run out of runway. The window to protect yourself is closing. Do not listen to what they say in press conferences. Watch where the liquidity flows. Every system is pivoting, the wealth is moving. Try not to be on the wrong side of it.